Right now, the global bond market is an Olympic high wire act. Japan just climbed onto the wire with a 300% debt to GDP backpack and promptly did a backflip. The 40-year Japanese government bond just punched through 4.2%, marking the highest level since Nintendo was pitching the Wii. You know, back when the iPhone had one camera and no selfie mode, the Bank of Japan is tiptoeing away from yield curve control. The buyers are starting to vanish, and overnight, the longest dated paper in the safest corner of Asia is trading like a junky Indonesian nickel miner. So let's give a first principles breakdown really quickly before we get into why this is bullish for Bitcoin. Number one, we gotta talk about the price of money. Bond Math 101, the price equals the discounted stream of coupons. When the coupons stay fixed but the discount rate jumps, that's when the price just caves in. The long maturity just multiplies the pain because each extra year is another whack of the discount rate sledgehammer. The 40-year bond has a duration north of 20, so a 1% yield pop wipes out roughly 20% of the principal. That is equity markets drawdown territory that is baked into the so-called risk-free asset. So if you're asking why the yields jump, you need to look at something called the supply and demand. When it comes to the supply, we know that Japan needs to refinance a sovereign balance sheet larger than the Eurozone economy. And when it comes to demand, we know that insurance companies and banks, they hit solvency caps and their risk models start to scream sell duration. And then you see a monetary exit where the Bank of Japan reduces the bid size, so the real buyers must step forward, but only at a credit spread that they would consider to be sane. And then you see the four-handle yields. So when we look at the United States parallel, we know that Washington is delivering a $602 billion deficit in the same opening quarter. They are financing it by auctioning treasuries to the same global pool that is suddenly filled with these Japanese government bond refugees. 10-year treasuries parking at 4.3%. That looks very cheap until you notice that net interest already crowds out NASA, the State Department, and the FAA combined. You're seeing the bond yields rise in every country throughout the world because we are in a sovereign debt crisis. The bond traders out there, they're going to stop treating the 10-year like a discount rate reference and start quoting it like an option-adjusted spread on Capitol Hill gridlock. The risk-free myth is dying before our eyes. So remember, the credit risk equals the probability that the coupon's purchasing power collapses, and we know that fiat doesn't really have a great track record of preserving purchasing power. So in addition to that credit risk, we also have to remember something called liquidity risk, which is the chance that you can't offload the bonds without nuking the price. And then when you combine the credit risk and the liquidity risk of the sovereign paper, of these sovereign bonds, it is morphing into collateral that ages like milk the moments that confidence wobbles. And look at just what's happening to gold and silver right now. The confidence in the world governments continues to plummet. So what situation are we in right now? I want you, dear listener, to picture Warren Buffett in your head right now. You know who Warren Buffett is. Picture him in your head right now, walking into a Vegas casino. He finds the craps table that's labeled sovereign debt, and then he looks at the dealer, and the dealer says, "House edge, we'll tell you next election." Buffett then decides to pocket the dice. Then he heads to the Bitcoin blackjack table where the rules are hard-coded and the dealer can't print extra cards. So what does this mean for Bitcoin? Well, this is a rate sensitivity inversion, because we know that the governments of the world, they have no choice but to continue to devalue their currency. And when you denominate the value of Bitcoin in fiat, what do you think happens? You have to start to see collateral migration because the world runs on collateral. Bitcoin is pristine collateral, the best collateral in the world. Hedge funds will eventually have to repo Japanese government bonds at punitive haircuts. The swap desks are going to ask for more margin, and capital has to pivot toward assets that settle in 10 minutes with zero counterparty risk. Remember, risk in the world is mispriced because the thing that they are calling the risk-free rate is actually the most risky. The hardest asset with the tightest float is going to become the new bottleneck for the global capital seeking an escape hatch. So we know that the precious metals out there are flashing this debasement warning. It's pretty obvious by now. We just saw gold go through the price point of $4,750 per ounce. That is a tiny brick of metal worth more than a mid-2000s Honda Civic. The barbarous relic has upgraded itself to luxury EV overnight, all without a marketing department. It really just had Peter Schiff tweeting about it every day. So it's obvious at this point that we are seeing central bank gold buying totally en masse, up 72% year over year. And when you look at silver, that has rocketed past $95 per ounce. So we're seeing bullion outpacing every S-curve tech darling while doing absolutely nothing. There's no earnings call, no CEO apology tour, just elemental scarcity that's not as good as Bitcoin's. And then you're seeing silver at that $95. The industrial cousin is moonwalking behind the big brother gold. So what we're seeing right now, the real yields that are offered by the world governments, they are dipping below the perceived currency risk. And now we're seeing the inert metal earning that implicit dividend, the sleep at night premium. And then in the middle of all this, you're seeing central bank balance sheet chess because the banks have to start considering, what do we stack right now? Is it gold as tier 1 collateral? And then you have to think of the monetary thermodynamics. What do I mean by that? When I say that, I mean that fiat behaves like gas in a leaky balloon. If you expand the supply, the pressure equalizes through price levels. So that means that hard assets behave like solid steel, this fixed lattice structure immune to dilution. The energy will continue to flow from high pressure fiat to low entropy metal. And because unfortunately the world still perceives Bitcoin as a risk on asset, that just means that the Bitcoin holders have to wait a little bit. Sorry, it's just true. You have to remember that the precious metals, they always sniff currency debasement first, and Bitcoin typically follows. That has been the case throughout the asset's history. So gold and silver right now, they are the fire alarm in the fiat hotel. So why is the world staying away from risk on assets right now? Because there is a looming geopolitical powder keg, that's why. On top of all the tariff speak, the Greenland talk, you're looking at Japan's fiscal explosion. The prime minister scheduled a snap election and is handing voters a food tax holiday. So he's essentially stapling coupons to every bowl of ramen, and the Minister of Finance is funding the giveaway with fresh Japanese government bond supply right when investors are demanding a 4 handle on the 40-year bond. And then on top of that, you're seeing the US Fed leadership crisis adding some uncertainty. The Department of Justice is investigating the current Fed chair, and there are 2 people who are pro-crypto waiting in the wings for the job. So when you think of the global reserve managers that are allergic to political meddling, they are trimming their treasury allocations, maybe they're hedging with FX swaps, maybe they will revisit the dusty bullion procurement memo. But all I gotta say is when you think of the capital allocators out there in this environment, is it really surprising that they're asking before they're starting to allocate toward Bitcoin? Remember, these people aren't as orange-pilled as us. When all of the fiscal gimmicks stop, when all of this central bank drama stops, and when gold bullion hoarding lines up on all the same week, the capital has to search for the asset, and that search algorithm eventually highlights an orange logo that blinks 21 million. So right now, what we're seeing is a liquidity trap setting the fuse. The rising yields that are out there right now, they are triggering this cascade mechanic across the entire financial system. Because every basis pop on the long end, it slashes the bond prices, and then the value at risk models have to start to scream a little bit more, which means that the treasury market turns into a garage sale before dawn, and then you see a central bank fork in the road. And we know that this just puts them in the decision. The policymakers have to choose between painting yields with fresh balance sheet firepower, or they can let their credit plumbing clog. The first path, prints reserves, and the second path prints bankruptcies. And history shows that the money printer usually wins the coin toss. And what do you think happens to Bitcoin when more money is printed? Each round of quantitative easing, whether they're calling it that or not, that's going to dilute the currency units even further. That's going to push the real yields below inflation, and it's going to channel the overflow into hard assets. Always first gold, yes, That is historically the case, but then the 21 million ticket carnival ride known as Bitcoin. The supply growth of Bitcoin falls by half on a cosmic timer with our next cut penciled for April 2028. Michael Saylor is buying more than 4 times the mining supply every single day throughout 2026 so far. And he's not waiting for any parliamentary votes or midnight policy flips. The fundamentals are totally unchanged. We're seeing final settlement in 10 minutes anywhere electricity flows. Your private key is a sovereign passport that never expires, and the asset never faces a debit side haircut from an over-leveraged clearinghouse. The reality is that we're going to see Washington continue to issue fresh treasuries faster than new Bitcoin is mined, converting fiat into the classic melting ice cube meme. Every single dollar of fiscal overshoot is going to boost Bitcoin's relative purchasing power, pulling capital toward the only ledger immune to committee hearings and budget ceilings. You have to think of the macro positioning for Bitcoin as an asset. Think of the world where the bonds are moonwalking off their pedestal and the gold is filling the firewall role. Bitcoin is going to become the high convexity strike on sovereign credibility. This is the perpetual call option priced in scarce timestamps rather than central bank IOUs. The gold to BTC ratio is something that is shooting a warning flare right now at 52 ounces of gold per Bitcoin. The dial sits exactly where prior snapbacks launched parabolic moves for Bitcoin. Fun fact for you, but history's elasticity math is pinning 170K to 200K Bitcoin price targets inside an 18-month window, assuming that gold continues to hold its throne. Fiscal gravity will always work for the orange coin. The United States, Japan, Germany, Italy, all of the deficits are going to demand bigger bond auctions every single quarter. The real yields will drift beneath living cost reality, debasing purchasing power and herding capital toward hard caps. Bitcoin has already earned the role of compulsory portfolio chess piece, not fringe speculation, because math is removing dilution risk. So we're seeing the feedback loop in motion right now. The sovereigns will continue to overspend because they have to. That means the long yields are going to climb, the central banks will have to cap yields, and liquidity will continue to hunt scarcity, and then the Bitcoin float tightens, and then the tight float lifts the price, and then the mainstream allocators out there have to chase performance. The capital flows will shift into Bitcoin because they have to. And if you want to be positioned before that shift happens, Swan Private is for you. Swan Private works with high net worth individuals, families to secure a generational Bitcoin position with no paper IOUs, and they help you do it securely and strategically. We are living through the greatest wealth transfer in the history of humanity. If you are orange-pilled, you know what's coming, so be secured in your position today. Visit swan.com/no-second-best to learn more. My name is Adam Livingston. I am the Bitcoin Wizard. If you enjoyed today's content, please like this video and subscribe to Swan, where we bring you the daily Bitcoin insight with more energy than anybody. Have a terrific day. Do not party too hard. Class dismissed.